stocks are off to the races. But my next guest says the Fed's shift won't lift all boats, especially in retail. It could actually hurt earnings for the majority of his coverage. Joining me now is Simeon Siegel. He's an analyst with BMO Capital Markets. Simeon, if only everyone would do a note like this. I love hearing about the nuances in terms of the top level rate cuts we talk about and the impact on your coverage universe. So what jumps out?
Hey, Kelly, good to see you. So listen, I think everyone hears rate cuts and they think, okay, companies and people will have more money in their wallets and therefore everything is great. The problem is, if you think about it from a corporate perspective, the rate cuts help those who need money. And a lot of retailers are cash rich post the pandemic. And so what we looked for was okay, growth businesses that need money and growth stocks that are valued accordingly. Companies that are heavily in debt stand to benefit. But oddly enough, the healthiest businesses, the ones that have been building up their balance sheets and have watched, like you and I, your personal ability to generate cash, the savings on cash go up, those will see pressure. And so what we found, so you mentioned earlier, Birkenstock, Lifetime, Planet Fitness, we saw these businesses that actually stand to benefit pretty tremendously across various different angles. Those are going to be the ones that are going to benefit from a rate cut.
And explain, Simeon, before you go from there, and most people's minds wouldn't go, rate cuts, Birkenstocks. Why does that company in particular jump out to you as a beneficiary?
So the way we were thinking about it, so we basically created 3 buckets and then ranked our group accordingly. And so what we looked for businesses that were growing faster, because if you think about it, growing faster needs the ability, cost of capital going down will help that growth, but also what a multiple is, what a forward multiple is on growth is what that discount, what are the present values worth today? And so if I lower my interest rate, then my discount value goes down. The present value of those cash is worth more now. That's very different than companies that have multiples that are not based on future value. They're just based on consistency. And so Birkenstock is both a growth stock and a growth company, like others in my group. And the reality is having debt in this scenario helps. Not because having debt is great, but because having debt was expensive. And so when it was variable, and we watched a lot of companies see that funding cost continue to rise.
Exactly.
If you now believe it's going to come down, that's a relief point.
And you also put Lifetime Fitness in that category. Is that because it's capital intensive?
And they're actually, so the third bucket, which is a little bit lazy, was our miscellaneous bucket. It was who's levered to financing. And so a company like Lifetime, which is working on potential sale leasebacks, sees a benefit there that had been a pressure point. Company like Planet Fitness, as an army of franchisees that need to tap financing to build units, is another one of these miscellaneous buckets. And so it's this idea. It's funny. It's counterintuitive because it's the businesses that otherwise were hurt. It's the businesses that theoretically looked less healthy that all of a sudden now look that much better.
And I think that makes sense on some level. Let me ask you then, you're sort of saying, look, as we go through this, there might be a lot of companies that are adversely affected. Who are they and why?
Yeah, so this is similar, following that counterintuitive part, and I want to be clear because I'm about to knock good companies. Like that's what this is. This note was let's isolate a very specific factor as opposed to let's look at the health of the businesses, because what happened in December where stocks moved, not tied to numbers, they were tied to the rate conversation. And so what my team tried to do is we tried to isolate stock movements that went too far versus ones that didn't go far enough. And so, for example, our math was last quarter, Gap, Ross Stores, and Ralph Lauren saw tremendous lifts from that cash yield. When you're generating such a return on cash, you watched a number that used to be interest expense turn to interest income. And that's been boosting EPS. And so if that were to diminish, the value that you'd get by saving on your cost of borrowing versus what you'll lose from that free money that cash has given you could actually weigh on earnings. I want to be clear, it doesn't impact the EBIT, doesn't impact the fundamentals of the business. But these businesses that trade on profitability, if they trade on EPS, they've gotten that lift. And I think they've gotten it quietly. I don't know if people have fully appreciated how much earnings have been boosted. We've seen anywhere from low single digit to low double digit equivalent of an EBIT number from interest income. It's a big lift.
That's really interesting. So basically, and there's a lot of the public out there who sort of has enjoyed, yes, they don't want inflation, but they've been making money on their savings in a way that they never did previously. And that's been true for corporate America as well. And all of a sudden that's going to go away.
Yeah. And listen, I think even the way, it's probably not all of a sudden going to go away, but it's all about the incremental. It's all about that second derivative. And so what we did, what was fun in this report was we created a scatter plot where we just matched stock movements in December versus who we think will benefit versus not. Because Listen, I'm nowhere near smart enough. I'm not going to pretend to call whether and when and how far interest rates are going to go. But it does seem like that's going to be a conversation. I think you and I are going to be talking about this over the year, where we're just going to have to figure out, did things get better or worse for these companies because they traded on that second derivative on the way up?